All right, welcome everyone. This is about angel investing. What is it and how do you get started? How do you move forward? Welcome, Jyoti, and everyone. Glad to have you all here today. I'm going to go ahead and get started, and perhaps we'll have more time to talk later with this. All right, so I'm going to share my screen and start the slideshow. All right, angels. Okay, why angels invest? Can everyone see this okay? Is that coming up okay?
Yes.
Yes.
Okay. So I'll do really quick, and I've got another screen on this, but so angel investors are people who invest in early stage startup companies with their own money. That's really briefly what an angel is. Okay, why do they invest? Well, one thing to be aware of is that many countries have legal requirements for you to invest. It's partly because it's very high risk, but it's also very high return. And so in the UK, if you're coming from the UK, you need to be what they call an eligible investor. I have more on that later. If you're coming from the US, investing, if you are a tax resident in the US, then you need to be an accredited investor. The EU also has general regulations for investing in early stage startups. And each country in the EU will have its own little tweaks on that. Okay, so why do startups need investing? And we have several companies here who could probably go into much more detail as to why they need to be invested in. But it's considered fairly normal for a startup to get some money from their friends and family, and some people say fools or other founders. But that's not usually enough to get them through to the point where they're being profitable. And this is sometimes called the valley of death. And so this is a real key area where startups need investing and where they're working on getting their customers and working to scale and to get things coming together. And so, and I know this looks like it's smooth and clean, but anyone who's done a startup before, you probably know that it kind of goes in and out, bouncing depending on the market and other things. And so there are a variety of reasons why a startup will need investing money. Okay, so what do the data show in terms of return? So this is the part that is very risky. So let's say that you have 10 companies that are very reasonable companies. You've done due diligence. They look like a good company. Everything looks good. Out of 10 companies, three will fail, the blue area. Three will return, but not as much as what you put in. Three will return, but not much more than what you put in. And then one will have a good solid return. All right, so that's what the data shows. And this is with companies that have already passed due diligence and look good. All right. Again, some numbers on this. Most of them, if we're looking at 2.5x multiple, if you're getting that on average, you're getting about a 2% IRR. In the 20 years that I've been investing, I've gotten about a 20% IRR. And that's not perhaps not quite as good, but I've had more successes with that. So fewer failures, and that's still pretty good with that. Another thing to pay attention to is that it takes a long time. This is not something that you're going to get a return on every year. And so, for example, I had an exit last year that happened, put the money in 15 years ago. And the kind of the joke that has been going around is that in the US, the average angel relationship lasts longer than the average US marriage. I don't know that that's true. I've been together with my spouse for 45 years, but perhaps in other cases. Yes, Stefan.
Marta, I have a question. So when you say your portfolio generated a 20% IRR, does it mean that I assume in your portfolio there is still a good proportion of active investments? Um,
Yes. Yes.
did you
Absolutely. Yes.
exclude those or how?
Yes. I
how-
just excluded them. These are only ones that have either died or exited. Yes. Good question. Thanks.
Okay,
Yeah. And I still, in fact, about 75% of my portfolio has not returned anything yet.
but it's still alive.
Yeah, they're still alive, still going. And there are two that I think that I'm expecting in the next year to exit. And so actually I'm expecting my percentage to go up in the next year or so because I'm expecting they're doing really well.
Mm.
They're growing great. One is a med tech company, and they got through the FDA process in about March. And so they're now in the medical, so not quite a year ago. They're now selling to humans, and I expect it to explode and get really big. And in the next year or so, I'm expecting that there'll be an exit there. And then I can say that I've got 22% IRR. At least
And
that's
sorry,
Okay.
just to clarify, sorry, the 22% IRR is then from the 25% of your portfolio, is that right?
it's from I've got the specific details. It's from let's see, it's from about 5% of my portfolio. And my return has been about 20% because I have so many that have not yet exited. This is on average what is expected, about 22%. And I'm a bit lower than that because I have so many investments that have not yet exited. Thank you. Yes, good question.
Yeah, thanks. Thank you.
Is anyone else in this group has experience with IRR and measurement and or point of
Yeah,
view or?
good question. Jasper, as I recall, you haven't had any exits yet, or have you had exits? Am I wrong?
No, none of mine have exited yet, but they're all still going on.
Mhm.
And if I look at the unrealized values of them, because some of them have gone on to do subsequent raises, so they've got current valuations. I'm looking at a way bit much higher than a 2.5. X on mine. So one of them is looking to hopefully exit in the next 18 to 24 months at a 10x plus. And then some of
Yeah,
my more recent investments have also gone and done further fundraisers and the valuation had doubled. But just to note, that is unrealized.
yeah, has gone up. And that if a company is going to fail, it normally happens pretty quickly. And so the fact that she's been going for 10 years and none have failed yet, that's a good indication that she will probably be successful with those and that they will come out. But this is very risky. This is very risky, even with good companies, even with careful due diligence. It's it's very risky. So why would anyone do this? High risk, high reward. It does have a very high reward usually. Yes, Susie?
Hi. Basically, I'm wondering, okay, IRR is quite clear to me, but once you have an exit with startups, what's your deal? Do you also follow something through when it comes to exit or not? Because I have seen different practices, so I'm interested in your practice. So once it's exit, what does it mean for you in your particular case?
Um, I don't double down on companies
Okay.
usually. Um, I invest in very early stage companies. I invest a small amount. I invest as part of a group, and generally, and I don't usually double down. Now, that said, sometimes I do, but um, and actually, I've been doing that more in Africa. Excuse me. So next week, our presentation will be about Africa, and it's a group that I'm probably going to double down on. It's just been and that I partly do because um, it's Well, it's been one of my very best investments in terms of returns, and I also really like what they're doing. I think that morally what they're doing is really excellent. And so I believe in what they're doing and I want to be a part of it. It's a way to I would donate for what they're doing, but it's great that I get a chance to get a return on what I'm doing. So I feel like I'm sort of donating, but I also am looking forward to a return. Melina,
Yeah,
thanks.
thank you.
Hi, I have slightly different question, and maybe it's silly question to someone, but I need to ask. Do
Absolutely.
every single angel investor expect exit from a founder or from the company which they are investing in? Because what I am trying to understand whether you only watch your return and you just see that the return is being reached, but it doesn't mean completely that the company needs to exit. Like I will give you an example. For instance, for us, in our case, we would like to continue with our business. Obviously, we have our exit. We know what we are going to do in 2 years, in 5 years, or eventually, like what's our exit. But we don't anticipate to exit very quickly, like smaller businesses, because well, that's what we are doing. It's massive. And how do angel investors consider the situation? Can something like that put them off if I say that our exit is quite long way through rather than
Yeah,
they can
excellent
expect
question.
something
Excellent
within
question.
the
Okay,
next
so
months or years?
right, I've jumped ahead a bit, and we'll see what kind of timing we have. In order to be a good angel investor, and by this I mean in order to get good financial returns, then you need to make many small investments over time. So ideally, you're making at least 20. As I say, I've made about 80 investments over time. And once you've made 20 or more, then the probability that you will be successful, that you'll get a positive return, is over 95%. So if you've made 5 investments, let's say you get really excited and you've made 5 investments all in one round. The danger with that, I'm going to check my chat to make sure I'm not missing, um, is that you're not doing it over enough time. And you really need to be doing, oh, okay. All right, thanks, Manmeet. Okay, and then we've got a bunch of, okay, thank you. So the keys are you need to make many small investable investments over time. So I make about 4 or 5 investments a year. Um, don't you want to make sure it's less than, since again, it's very high risk, you want to make sure that it's less than about 10% of your investable wealth. So you don't want to be, I can tell you horror stories about people who have, I have a friend, she put half of her retirement money into a few investments, 5 or 6, and basically lost it. Don't do that. Don't do that. You want to make sure that you're being careful with it. You also want to make sure that you do very thorough due diligence. And I recommend that you invest as a group. And now Jospo's done very well investing on her own. Let me talk a bit about why you might want to invest as a group. And then you also need to know yourself. What level of risk are you comfortable with? And people say that women are not they're not willing to take as much risk as men. I would be on the way risk averse end of that. I invested probably for 5 years before I started getting returns, and I started going, oh, look at this. If I do it and I do it carefully, and if I do it well, I actually get really good returns. Okay, when we say due diligence, good question. And how do we connect? All right. All right. So Actually, I was going to do an entire session on due diligence, and so I won't get into a whole lot of detail now. Susie, yes, question.
I'm sorry, can I jump on and reflect on the very same question Milena has asked? From my point of view, I like startups who do not exit. So I have maybe some preference who plan long term, and maybe it's due to the fact that I built my own company, bootstrapped myself, hard way through hardships and difficulties, and I am probably a bit emotionally attached to those who are willing to play hard and succeed on the long run and have a huge potential to go global. And I'm supporting them all the way. So, of course, exit is
You're right.
quite good thing in terms of profit. However, on the other hand, I believe when your little baby, like the startup you're supporting, grows into SME later, a huge thing, I think that makes your heart grow as well, and of course, your revenue as well, depending on the deal you got.
Yeah, yeah. There are a lot of ways to do this, and part of why I like angel investing is that it gives me a chance to build a relationship with the founder and with the company. And so I advise groups, startup groups, and I help them, I hope, be more sensible. I also, if you think of an angel investor versus a VC, and this is a generalization, which is not always true, but in my experience, an angel investor is normally interested in someone being slow and steady over time, whereas a VC is often pushing you to be really big, really fast. They want you to fail quickly if you're going to fail, and then and then succeed big if you're going to succeed. Yes, Stefan.
I wanted to add to the exit question that so when angel investors do due diligence, they also look at the exit strategy. So they try to get a view from the founder if they have a strategy in mind, which doesn't mean that it should be like selling the company as quick as possible, but at least having it somewhere considered. Because I mean, this whole equation here with the 20 investments, it only works if every single of the 20 has the potential to be very strong and also to exit. And if the portfolio consists out of startups which have an average market, like an average case in terms of market size and revenue and no exit strategy, it would not end up with 20 to 25% IRR. So there was a discipline somewhere in another slide. I think that's also part of it to only allow startups with a strong case and an exit strategy to be part of the portfolio. Otherwise, it doesn't work.
So I can send out, if you'd like, I have a spreadsheet that I use for doing due diligence, and I can send that out to everybody if you like. Now, I will give you the caveat with due diligence. As Stefan said, you've got to be very thorough. You've got to be very careful. And with my spreadsheet, the spreadsheet is neither necessary nor sufficient because different kinds of companies have different kinds of ways that they work. Like a med tech company um, will not have income. They need to get through too much research. There needs to be too many stages that they go through before that they can have income. And so while I do have a line there for income, I recognize that a med tech company is not going to have income, and so that's something that I'm not looking for in a med tech company. Okay. Let's see. Okay. So as we discussed earlier, about 75% of Mossy Ventures of the particular group I've involved in um, have not really had returns, but of returns that we've had, they've been actually about twice what you would expect from the normal data. And I believe that that comes from working in a group. So you have two kind of contradictory things that are happening when you're doing due diligence or when you're looking at a startup company. One is you need to be looking at something that you know really well. But on the other hand, you also need a lot of diversity. So how can you do that? How can you manage that? And doing it in a group is a good, solid way to do that. Here's a bit more. All right, so need to work in what you know. The more you can have a relationship to the industry, the better your returns can be. So you need to know, or you need to be in a team with someone who knows the industry really, really well. And that's a way that you can expand your knowledge because maybe you're a med tech person, you understand the medical field really well, but then someone else knows a lot more about business and about finances and that sort of thing. So perhaps on the team, you look at the med technology and make sure that that's solid, or someone else on your team goes through the financials and make sure that those are solid and that they're getting you, that they know what they're talking about with that. Okay, we talked about this briefly before. The expectation is that you're going to hold on to it for multiple years. And as I say, we had an exit last year. It was a 2.5 exit. We'd held it for 15 years. Not the best, but I mean, it was an exit. Hey, I'll take it. And you want to spend more time on due diligence. This is another reason why it can be really useful to be part of a team, so that if you look at this, if you're spending about 30 hours, you'll get about 2x better multiple for 20 hours or more of due diligence. That can be a lot of time to go through 20, 30 companies and find out which are the best companies. So that's another reason to do it with a team. Not that you can't be successful on your own, but that's part of the theory, the philosophy of what we're doing with our angel conferences is we're bringing together people working as a team. There are different levels that you can do. There's the due diligence team, the lead. Our goal is to help people to become a lead investor and a fund manager. So we have over 1,000 graduates of our program, of which about 40% are still doing angel investing, and about 20% have gone on to be fund managers. And another 40% have run away saying, wow, this is crazy. What are we doing here? So it's an opportunity to learn more. Our general goal is to help everybody move forward, to make better investments, to help support the angel investing and the startup community. We've been in Seattle for 15 years. We've been in Europe in general for about 5 years. And we're just starting now to focus on London and the UK and focus on there because of all of the advantages of being in England. There are a lot of tax advantages. There are also tax advantages in the US, depending on which country you're in, where you're a tax resident, there might be other tax advantages there. All right, so what sort of options do you have if you want to do angel investing? You can be a lone wolf. A lot of people do this. A lot of people do this because they don't trust other people, which is great. I understand that. And then they work with people they know, they work in spaces that they're very familiar with, and they have the money and the resources to do it alone. Most companies, and we think that it's not fair to a company to invest less than about 50K in them. So unless your net investable worth is about 10 million, you probably should not be doing loan worth. Then there are active angel groups. I looked up some in the London area. There's London Business Angels, 24 Haymarket, Ventures Together, and then we're the SIAUK group. Then there are passive angel funds. All right, so with the active angel groups, the angels do the due diligence. They explore each of the companies and they work through them. With a passive angel fund, the representatives do the due diligence. So they consider themselves experts. There's a group that I know of that's called Venturous, and the representatives do the due diligence, but then any angel who is investing is allowed to go through and do their own analysis of the company and then let the investors know what they think what they think are the best groups to invest in. So here are some others that are possible. There are angel networks, which are basically a group of lone wolves, like the Angel Academy, and what that does is that helps you with deal flow. So they find companies, excuse me, and they pass the companies on to you. You can do what due diligence you want, and then you can invest in what you want. There are online platform syndicate ones and it's often a network. So this would be like Angel's Den, Angel Investment Network, Cedars. And then there's often an accelerator, micro VCs that are again, this is passive. There are other people who are making the decision as to who to invest in. So there are a lot of different ways that you can invest. And my philosophy is that anyone who's willing to invest is making the space better. So whatever works best for you, I would encourage you to consider it. I would say please be careful. It's a very risky space. Like we mentioned earlier, aim for at least 20 checks over time, at least 5 to 10 years to get to 20 checks, 20 companies you're invested in. And if possible, do nice small checks so that you're not investing too much of your investable wealth in that. Okay, I can talk more about companies. Anything else about investing? Let me look at everybody.
I have a question, Martha.
Yes.
Do you have experience with startups paying dividends?
No, I haven't. Well, let's see. I've started doing some things in Africa that might be might be paying dividends. There's also something called um, I should have written it down. Where revenue redemption. I don't know if you've heard about that, but that's an opportunity to uh, this actually happens in or has happened in Africa and some of my African investments, where the goal is not an exit. The goal is that the company is going to get bigger and bigger eventually and grow, but they're not going to exit. This is going to be a long-term company, a long-term business for the founders. So how do you get your money out? And once they get profitable, then they take a percentage of their revenue, and then you get that money back until whatever you've agreed on with a 2x or a 5x or whatever you've agreed on with that. And they have a certain amount of time that there's their goal to return that money. That I really like because I see that that doesn't depend on an exit. That doesn't depend on getting really big or being bought out. That's a way for people to build up their community and to build up their revenue and what they're doing in a way that I get my money back with a good return and they get the finances they need in order to move forward. Yeah. Other questions? Yes. Susie? Oh, you're on mute.
Okay, I will learn my laptop for next time. Basically, what you said is usually a practice in Eastern Europe, especially in Eastern European countries that are considered a bit less developed. So dividends are quite common when it comes to investments. Ukraine did it, Serbia, I have seen cases, and it's quite a practice. Croatia has such practice, and sometimes the reason is that investments are not so regulated. So um, the startup culture is high and everything. However, the administration and finance and government is behind the regulations that should be, so behind the practices. So dividends are quite common in Eastern European investments, by the way, which is, as you mentioned, quite a good thing. It, even if you have an exited company, you still have like dividends, or later can be transferred to shares in the respective company.
All right. Great. Thank you. Milena?
I'm coming, I'm here. Why the due diligence or why the due diligence take such a long time? Because I do know that it might even take a few months. Why? And whether it could be replaced by technology, for instance.
Some of it I think, can be replaced by technology. I don't think all of it can
Okay,
because a lot of it is that you are developing a relationship with this company, with this founder.
right.
And so, yes, some things like you can go through and you can say, do they have this document? Yes. Do they have this document? Yes.
Yes.
They have that document. And so that sort of thing absolutely could be automated. And he's not here today, but there's someone who is building has built an app to do that.
Mhm.
I know that. So I was in Portugal earlier, I guess last year, and they one of the investing groups said that they don't like to invest in less than 6 months. They like to do a
Mhm.
6 months due diligence
Right.
because they're building a relationship with the team,
Okay,
with the
makes
company.
sense.
Now,
Right.
that can be awkward if you
Mhm.
need the money right now.
Mhm.
But if you're building a long-term relationship,
Mhm.
I mean, I, I do often talk about it as if you're getting married.
Mhm.
This is a long-term relationship, and you don't want to,
Yes.
as a company, you don't want to take the first, thank you. You don't want to take the first investor necessarily.
Mhm.
And as an investor, you
Mhm.
don't necessarily want to take the first company. You want to spend time with them.
Mhm.
And so our program is 12 weeks, which is about 3 months.
Mhm.
And and on a regular basis, you get a chance to talk to the founders
Mhm.
and to meet them and to get to know them better. And to find out, are they dependable? One of the things that I say when I'm talking, when I'm looking for a company, what am I looking for in a company? I'm looking for team, team, team. Who have you got? What are you guys doing? Are you going to follow through on this? Because it is, so I've done two startups myself, or
Mhm.
two early stage companies myself. It's hard work over a long period of time. You need to be in it for the long run, and you need to know about the founder that they're going to be in it for the long run. Yes, Jyoti.
Absolutely. Thank you.
Jyoti?
Sorry, I was muted.
Okay.
I said I have a couple of questions. The first one is, so angel investing mostly is in targeted at early stage founders who are or more, and generally typically first time founders, and who are solving little bit of I mean, not really like sexy problems, like what I'm getting to is, like the companies like OpenAI, like how do you get to OpenAI of the world because even if they are my first time founders, I've seen they usually don't do angel. They're solving such a great problem, or they are connections, or they are multiple time founders, that they don't go through this. So is that right to assume that we don't aim at those open AIs of the world? And my second question was that how much, at least especially as an individual angel investor, or even as a group, how much influence do you have on the founders or the startups? Because you said you do advise, but if I'm giving a small paltry amount or whatever, like how much, can I have that relationship?
Yeah, I got 3 or 4 questions in there, but let's see if I can remember what they were. Good questions, really good questions. So I do early stage partly because I don't have the money to do later stage. If we're doing Series A, they're looking at raising, $3 to $5 million, and so I don't have that kind of money, at least not to burn, right? And so. On the other hand, we have had people apply to our program because they specifically like the relationship building that we do in the program. So the founders, even though they were raising Series A, they were willing to take our smaller checks because they wanted to build the relationship. So that was part of what they were after. And I have invested in later groups, but at later rounds, but always as part of a group. So that's part of what goes on there. I've invested in AI. I've invested. We are we're agnostic in terms of what we'll invest in. We generally, as a team, want to be investing in someone who is not looking for more than about 1.5 million, because we do want to be a fairly significant part of that investment. So how much influence do you have on it? That depends on what you write up. Maybe you write up that we're going to have somebody on your board, so we're going to have somebody engaged all the time. We always have a lead investor, and that lead investor will be more engaged with the company over the long haul. And so that person should be meeting with them on a weekly basis. Jessica, were you the lead investor for the IBAP?
Yes.
Okay. All right. Do you want to talk about that a bit, about what the experience was with that?
Sure, yeah. So, as the lead investor, I spent a lot of time understanding and negotiating the deal terms with each of the companies. So, and that's very important because even though a business, once you're doing the due diligence, commercially could make a lot of sense, and you could see the plan of returns and the exit plan and the milestones within that. If the deal terms, which for us as an investor are not right, it would change it effectively from being a good deal to a bad deal. So that's thinking of what the company's valued at, what share that we would get, what involvement we'd get, the type of shares we'd get in that. So that's very important as well, because the company could, if you just focus very much on the company itself, but not the deal terms, there is a risk that actually the return that you'd get wouldn't be what you've anticipated. So both are equally important. And you really do build that relationship with the founder throughout the journey. So I'm getting all the board reports, all the updates. I'll have regular calls with her, with the founder, and she'll reach out to me. I'm making some connections to her. I reach out to some of the investors to see where they could make certain connections to help the business grow. And that for me is, and that's what I really do enjoy about angel investing, is that I'm on that journey with the company. To what extent it is. So some of them I'm less involved on, but it's still something I'm always, I know what's going on. It's something I'm always going to try my best to ensure I'm able to connect them, from whether it's growing from a customer base, whether it's from a supplier base, or just a broader network. And I think that's the and even just being a sounding board sometimes as an angel is enough for a founder, because founders are often quite lonely. And just because, I mean, I've never been a founder, I'm from a very finance corporate career, but actually there's always some value that you can add, and just being that sounding board for the founder. And that, you know, for me, that's also is that value I'm able to add beyond the ticket, which is what I really enjoy doing, and hence I do more angel investing rather than putting my money in funds.
Great, thank you. Yes, and the connections is one of the big things that angel investors can give to a founder. Antonio, question? Where'd you go? Doesn't look like you're on mute, but I'm not hearing you. Maybe a question in the chat. Okay, so he's going to move to mobile. That might take a minute. So there, and that's part of at least what I see is what angel investing is doing. What Jaspal was saying about how it's more of a relationship. It's not just okay, get out, get your exit, boom, boom, boom. But what can I do to help you? What can I do to support you? And I don't normally double down. I don't normally invest again. But even if I can be making connections for you, if I can help you find other investors or whatever like that, that's part of what I think an angel investor is for. So, and I've known angel investors through our program who have gotten so excited about the program that they joined the team. They became a co-founder with the team and helped them become long-term successful. I don't know, I should know the end of that if they had a positive exit or not. I'll look into that. I don't remember offhand, but there are a lot
Okay.
of opportunities. Yeah, Jyoti?
Yeah, no, great, thanks. Yeah. No, that's yeah, good to know that the relationship and the influencing part, especially as a group, it's more, I guess you have more of that. Or if you are anyways a lead investor of a fund or something. But so then just for the first part, then just to would it be then correct to say that we are not targeting as angel investors the open AIs of the world, even if they are founded by first time founders?
Oh, right. And there's the first-time founder question.
Or yeah, like somebody who's solving really, because I come across companies in AI, that's my field. And
Mhm.
UK, I've seen this just change when I started exploring. I come from Silicon Valley. So when I started exploring here, I was like appalled. Like people were not even looking at more than like, say, somebody were looking at 100,000, 500,000, which is like literally like change from California, US. But
Right.
then over the last year, I've seen actually companies raise to 35 million, and they are good companies. But I'm just wondering if I would have even it would have been even possible for me to invest in those, because some of them didn't even go for angel. You know, they were such great ideas that they got pre-seed or whatever, or VC backed funds, somehow they got it. So I'm
Sure.
just
It takes more than a good idea. As I say, I'm looking for team, team, team. The right team with the wrong idea will pivot and go to the right idea. The right team with the wrong idea, let's see, no, so the wrong team with the right idea
yeah, wrong thing.
will die. There was a company that I would not invest in after I did due diligence, and all of their paperwork, everything looked really good, but they were all academics. And I've been an academic myself. I don't mean to say that academics are not uh, capable people, but they had tenured positions they could fall back on. When the going got tough, I just didn't trust that they were going to continue to work on this. And they didn't have anyone who really understood what it means to do a startup. It's a lot of work. It's a lot of work over many years. And so you've got to find someone who understands that and is willing to do it. Yes, Jasper.
I was just going to add to what Jyoti was saying there, that some of those deals that you've come across, you mentioned they were such good ideas that they didn't come to angels, it just went to VCs. I think what you'd find is typically early on, some companies will bootstrap. It just depends very much on the business model, because could it be cash generative, or is it something that would need quite a lot of upfront funding? And it also depends on the growth mode, whether a lot of funding's needed in that. And often you'll find that a lot of companies will have had some private angel investing, but it's not something that's widely publicized. So often
Right. Yeah.
when you're seeing some of those companies and you're hearing them going through a fundraising process, that's often at the VC stage. So I'd say actually being an angel investor is even better, because you get an early go at getting into some of these great companies very early on. And also, the earlier you get in, the better the deal terms typically are. So you'd get more value and the equity percentage. So the deal terms piece I was talking about earlier.
Sorry, but how do you get to know these early on then? Like, how would you?
I mean, a lot of it's just through networks and putting yourself out. So some of the angel syndicates that Martha had mentioned earlier, obviously, what the SIA program does is you'll be seeing 30 plus companies, and SIA runs several cohorts each year. And obviously, if you're not part of those, all the alumni get a chance to also invest in each cohort that's being invested in. So again, you know that a company that's being put in front of you has gone through that same level of rigor and due diligence process, and you'll have access to those reports. So just being part of those groups and networks, and there's many, you'll find there's a lot of like Dragon Den pitch type events which take place, and I think you're London based, your
Yeah,
TV.
those I know. Yeah, those
Yeah,
I'm aware. So I'm just wondering, like, yeah, if there's another channel that you get to know if you're, yeah, that's fine.
it's
There,
just being
there are
Yeah,
there are a variety of different channels.
yeah,
There are many, many companies. And one of the things that we target with our program is what I consider, so there's kind of the high-end companies, but thanks, Simona, as just Paul was saying, there's also maybe not high-end now, but going to be high-end, and that's
yeah,
more what we target. So the earlier
right.
ones, higher risk, but
Yeah,
also higher
no, yeah, of
potential.
course. Yeah, makes sense. Yeah, thank you.
Antonio, is it working now? I hope.
Nice. Sorry. Thank you. Um, no, yeah, I've been doing some let's say also angel investing some time, and not much because my tickets are small. But anyway, and a while ago you were discussing the size of the tickets, and I was wondering on the co-investing. How do you? I mean, what has been done the co-investing? How do you think about it? That is something that I would like to explore more in some sense. Uh, because I think this is where we can, get more better deal or larger deals, and this can be more interesting. And so it has been difficult in that sense to do that, because then it's not being. I thought it would be easier to do that. I don't know, but again, I mean, looking to you from your side.
Yeah, so and our theory is, thanks, Andre. Our theory is that and the evidence shows that the more tickets you can do, the more smaller tickets you can do, the higher the return will be on your investment. So at least 20 over time. You don't want to do it all in 1 year. So we started in the US, and in order to be an accredited investor in the US, you need to have $1 million of investable funds. Working off that idea, you shouldn't invest more than 10% of your investable funds. So that's $100,000. In order to get to 20 tickets, that's $5,000 per investment. So that's what we have. We have a 5,000 unit for the investment, and if it's in the UK, it'll be pounds. Usually it's in dollars. and then you put the $5,000. Then everybody coming together, we work to have on the order of 40 investors. And so that's 200,000 for the company. That's a reasonable size for the company. It's enough for them to really make progress moving forward, and it's not too much of a burden on the investor. So it helps the investor be able to do something that is not as high risk. So that's the theory behind what we're doing, why we do that. And we found that that has worked throughout Europe, throughout the US, North America, and we're now also expanding to Taiwan.
Mhm.
There
Mhm.
are other options. I know of a group in Finland that takes €1,000, and you can also do like a GoFundMe if you want to do a smaller group like that. The I do like the idea. I think it's also really useful to have a lot of people going over the company and doing the due diligence in order to be more thorough. I think that's good, not only for the investors, but also for the company. Thanks, Harpreet.
Well, on our groups, we had ones who were like an investment committee, so and everybody was able to participate in the somehow the look at the pitch or assist, and then participate in then and then vote at the end of the vote, because this was more kind of a fund. I was wondering whether there is these options more informal, and then how we can do it.
How
Then
how you can access companies more informally.
yeah, or at least not as a fund, or
Mhm,
just
mhm.
because then it's the transaction costs is that
Right.
can start, yeah, and
Yeah,
so
yeah.
it's
Well, there will always be the transaction costs. That I was talking with one of my founders this earlier today, and she was kind of shocked that she was going to be charged 5% of whatever investments she
yeah.
got by the company that was building them, that was pulling in the investors. And I says, well, there's costs to managing an investment. And so that's not that odd, not that unusual that somebody's got to pay it. Somebody's got to pay the costs. And we don't like to charge the founders because we figure they're very early stage. They don't have a whole lot of money, so yes, we usually charge the investors. But not everybody does. I know that there's a group in Finland that requires just €1,000. There, are you, where are you, Antonio, geographically?
Portugal.
Portugal. Yes, so there's a variety of funding groups in Portugal that I
Yeah,
know of,
yeah,
that I
yeah.
met with when I was there last. And I don't know all of the details of their funding situation.
Well, there are several. That's why I was sometimes we see whether we'll join one or the other, what
Hmm.
happen, what you can do. But one thing it's into I think this is important as also business angel is that we are, as you said before, was telling us that we have to be closer to the startup. So get involved. I prefer to really to get involved instead of just being passive and
Yeah, yeah. And there are plenty of places that'll take your money. But right, but to go through and to get to know the businesses better, there aren't so many that do that. That is something that we do, is we give you the opportunity to look at 60 companies every round, and you're welcome to go through and and connect with any of them or all of them and get a sense of. That's part of our goal, is to give you exposure to the space and to how things work and how you can find people. So we use the Gust profile, and that's a way that you could find companies. You get into Gust, and they have hundreds of companies put their profiles in there, and you can go through them, find local companies, and work with them from there. They probably have thousands. I don't know. I know we never have any difficulty finding companies. That's not the problem. We have gone over time. I thank you for sticking with us, and I'm happy to stay and keep talking or whatever works for you. Yeah, thanks, Susie. And Susie will be doing a presentation for us in a couple of weeks.
Yes. So please feel free to suggest any topic that might be of your interest. I think my biggest contribution is negotiating between startups and investors, or like I think I can give better contribution with startups, startup oriented things such as if you want to choose the right startup from a social perspective as well, because I also include that in my due diligence. Because as angels, you need to pay attention to the kind of a group, kind of a company as people, individuals, and a group, just like Marta pointed out. And when it comes to startups, I have been educating startups for a couple of years and helping them polish up their game in order to get better investments, better people and clients in future interaction. So I'm open for suggestions. I would like to give my contribution and help you to cover topics that are of your interest.
Great, Susie. Thank you. And thank you for doing a
I got
presentation.
it on. I have one more meeting. So thank you very much, Marta and Jasper, for organizing this. This was a very productive workshop, and I know you put all your energy and brains. So it's not easy to organize such things. I believe it.
Yeah.
And thank you, guys. You are nice, and it's a pleasure that the group was really productive and nice.
Yes.
So I'm very happy to begin my Monday like this. So see you soon again.
Great.
Goodbye,
Yeah.
everyone.
Thanks.
Hi,
Thanks for everyone's
yeah,
feedback.
Mark, thank
hey,
you so much
sorry.
for this. This was really helpful. Just one quick question.
Yes.
After all the due diligence as a collective, will we invest in one company only, or would there be a couple?
We guarantee one investment.
Okay.
We usually have, so we do due diligence on 6 companies usually.
Okay.
And of the 6 companies, we usually have 3 or 4 that we think are investable. So a lot of times we'll put together a sidecar and invest in 2 or 3 of them. Excuse me.
Okay.
There was a company that we had last year, 2025, that they were in 3 of our rounds, of which they won 1 round. But through their interactions, yes, the due diligence, I'll be getting that out. The interactions that they had with the other investors, they were able to just about double their money. I think they got on the order of $400,000 in the end, because they were clearly a good company, clearly very interesting to a lot of people, and they were able, the founder, who was very capable, was reaching out to people and made the connections and was able to get quite a bit of money from their experience with us.
Okay.
It has to do with it has to do with a couple of things. Can you get enough people interested? And then we just had someone, and they were a good company, very investable, but they were a US company, and since the laws in Europe are different, most of the investors did not qualify to invest in a US company.
I
And
see.
so unfortunately, we did not get a sidecar. I think we had enough people, but they weren't US. They didn't qualify from the US point of view.
I see. And then is there like a minimum amount net worth wise you need to invest in the UK? Or do you
I don't like to invest less than 50K. I think that that's
Okay.
not worth it for the cap table for the companies. And ideally it would be more than that, but yeah, basically I won't I won't head a round of less than 50K.
Okay. No, I meant like as an individual, you know, in the US you need to qualify by having
Oh,
a million disposable income. Is there something like that in the UK?
Yeah,
yes,
do you want?
yes. It's $200,000 investable, 200,000 pounds
It's
investable, or $100,000 pounds a year. Is that right, Just Paul? Am I remembering
Yeah.
correctly?
So you have to just self-certify. So you can be a sophisticated investor. So if you work and earning even below the minimum salary in private equity, say, or in a VC fund, you can be qualified as a sophisticated investor. I think you'll have to, I think you are in banking, but perhaps in the credit fund, so you may be able to get there through that. But otherwise, you can self-verify as a high net worth individual. And then typically to meet that, you've got to be having a salary or an income of 100K per year or net assets of 200,000.
Okay, that's helpful. Thank you.
So, and
Yeah.
that's all,
Okay.
and look, there are ways around that as well. That's very much about, you know, that's just the bar that's been set in terms of making sure that deal flow gets, you know, effectively not marketed, but, you know, if you're getting access to deal flows, it's just making sure it's going to the right investor. So people who can make a suitable decision from an investment perspective. So that's what the criteria is. It doesn't mean if you don't meet those criteria, it doesn't mean that you can't invest. You just can't be marketed for investments or joint syndicates, etc.
And the
Okay.
UK tax benefits are really, really good.
Yeah.
That's it's almost worth me becoming a tax resident, except for that. Well, I've got other complications in my life, but
Then
yeah, it's really good in the
we'll
UK.
cover them. We have an event in person on the 5th of February where we'll cover the tax benefits more. But with EIS, and yeah, with EIS, if you're a higher rate taxpayer in the UK, once you join all the different elements of tax together, in case the company doesn't do well, through the money that you get on the way in from investing, plus the loss relief, you're only risking 37.5% of your capital.
Yeah, no,
So
that's
that
great.
could drive investment
Such a
decisions. But
deal.
I mean,
Such
look,
a
for
deal.
me, I wasn't thinking of becoming an angel investor. It just, you know, it happened so just with the founder I'd met and the introductions that had been made. And when I thought about it, the tax, you know, is what probably made me go over the bar, because actually getting that 30% on day one is helpful, because you also get the protection. So I think it's a great way. So even though tax shouldn't derive your investment decisions, it's a good way to start getting into angel investing.
Agree.
But Martha, if you're a US citizen, can you still get those tax benefits for if,
Um,
but you're
if
resident in UK like I
I'm
am?
I'm a dual citizen, US, UK, and if I were a tax resident in the UK, then I could, yes.
But if so no, you don't have to be a UK citizen for that, right?
Um,
Like
no, well, if you're a tax resident, you need to be a
tax
tax
resident.
resident. And I am a
No,
UK
because
citizen, but I'm not a UK tax resident.
okay, yeah, no, I'm a US citizen, but then you know, right? The reason I asked you is because as a US citizen, you always have to pay US tax wherever
You
you are,
always,
right?
always have to pay US tax.
But then, so that's why I was wondering, then can you still get these tax benefits if you've been residing in the UK?
Yes, if I am a UK tax resident. Now, as you say, yes, I always have to pay the US taxes. And so probably the key thing that is preventing me from becoming a UK tax resident is that for some reason my husband doesn't want to move to the UK. I don't know what's wrong with him.
Mm.
But and so that complexity of, married filing jointly across countries, I don't want to
Oh
deal
my God,
with
yeah.
I don't
No,
want
no,
to deal with that
I
just
advise
yet.
you, yeah. No, no, don't. It's so complicated. There are, yeah.
Yeah,
We've
maybe
we've been
next year.
paying so much just to get it filed. It's
Yeah, to
yeah,
get it
it's a
worked
lot
out.
of
And they have
because
an
it's so
agreement that
complicated.
it's
Yeah,
it's it's crazy. So yeah, I don't want to
yeah,
deal with that this year. Maybe
yeah.
next year. I do have a tax accountant who can do it, but not this year.
Yeah, not you need specialized tax accountants. Not everybody, even I,
Yes.
can handle US, UK dual tax.
That's right. You need a very specialized tax account.
Yeah.
And I do have a name. I don't want to deal with it right now.
Okay.
I have other things I'm working on.
Yeah.
Okay.
Yeah,
Other
that's fine, Linda.
questions?
Yeah. Mhm.
You've been quiet, Max. Do you have something?
I'm gonna head out, but thank you so much for this call. It was so
All right.
useful.
Good, good. Glad you could make it.
Have a
Glad to
good
have you.
Thank
All
you.
right.
Yeah, thank you. Thanks,
I think I'll
Martha.
stop
Thanks, Paul.
recording.
Yeah, thank you.